Obviously, markets saw some volatility and downside on Friday following escalations in the Middle East. As traders, we have to figure out if the market's going to use this catalyst to continue selling off, or if the bullish base case is still in play and we should be looking for a buy the dip opportunity ahead of the FOMC meeting this Wednesday. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly timeframe chart, talking about candle structure and location as we always do. In terms of structure last week, we do have a bearish inverted hammer. So the red-bodied bar, of course, means that the opening print is over the closing print, and therefore we can understand that buyers tried to break out, sellers offered a decent rejection near the highs of the weekly range, pushed prices back down to the opening print, but they didn't stop there. They expanded range in the downward direction, offering a red close under the open. That, of course, is bearish. So sellers get the check mark when it comes to structure. However, on the location front, bar-to-bar count does offer a substantial higher low as well as a higher high. The only concerning data point is that the close is technically back inside of the previous week's range. So on the bar-to-bar count, you're getting a little bit of a look above and fail, and for that reason, I'll go neutral on location, not necessarily bearish. And if we try to remind ourselves of the overall theme of what's taking place here on the weekly timescale, I don't think we want to forget that the idea is we're breaking out of a 3-week balance range from here. And although, yes, the market pulled back to end the week, we did not close the weekly bar inside of the 3-week balance range. Now, of course, a trade idea that starts to come to mind is if early on in this upcoming week we take out last week's low, it's very possible that we have look above and fail on the 3-week balance range, and we should target the bottom end of the balance. That would be confluence with the weekly 50 SMA, the blue moving average on your screen. So that is definitely a higher time frame idea that is in play here, but I wouldn't front run that idea. I would not just jump the gun and start to get short before the actual breakdown of 595, and we'll talk more explicitly about that level on the daily chart in just a moment. So what is the overall weekly trend, though? Is this a big short trade where, oh my goodness, the weekly trend is down and we should be looking for big new lows? No, absolutely not. We know that we have lows, we have higher lows. This is a soft higher low because the daily trend never flipped to down in here, and technically along the way we have a higher high, and this breakout is also a higher high. So if the weekly chart's pulling back from the highest high, of course it can afford to find a higher low in the trend count and preserve the overall weekly uptrend. Is it possible that we could close the China gap and still yield some sort of weekly higher low? Absolutely, because this is a soft higher low. So if we get a firm higher low via some sort of daily downtrend down towards this area, I'd still be open-minded to the higher time frames remaining in control of the buyers overall. Just as a reminder, if this is going to be some sort of massive monthly double top, don't forget you need to break that neckline, which is way down here underneath the tariff volatility lows. I just don't even think it's a talking point as of right now. If we quickly check in on the Fibonacci's, there's not going to be much of a change here. But coming from the tariff lows to the most recent high, you're well above the Fib 38.2. But more importantly, let's just say that the market does pull back to the bottom end of the balance range here. You're also still well above the Fib 38.2. That's kind of a non-issue. This is all considered bullish consolidation. If we come in from the top, the all-time high to the tariff lows, not much of a change there, but just trying to get a sense for where that 61.8 is. Once again, the China gap close is also well above that level. The more time that we continue to spend over the 61.8, the higher the likelihood that over time we do, of course, go on to produce the 100% retracement, aka a brand new all-time high for our market. If we clear that up and throw on the anchored view apps from a weekly perspective, we're above the entirety of the stack here, and what you'll notice is if the China gap closes, you have great confluence from this anchored view app right at that same level, so all set from that perspective. Let's take a look at our volume profile on the higher time frame weekly and just get a sense for where we're at. Are we backing away from the top end? We're going to treat this entire thing as a high volume node, so we want the top end of the high volume node, which is where we're pulling back from, and we want the bottom end of the high volume node, which is the bottom end of the 3-week balance range here. The volume nodes are confirming the key levels that we basically have in force as of right now. And also, if we were to move through the China gap, which is of course where this low volume void is, the next high volume node just below it is once again the gap closure. It's the anchored VWAP we were just looking at. It makes sense. We're looking for higher time frame weekly higher lows if the market goes on to produce a firmer pullback. However, again, we should not front run this idea. We should firmly wait for a breach of last week's low to trigger a sell setup and move back down into the 3-week balance range happening here. Now, something that I do want to acknowledge, but it's not going to be a driving factor for the analysis here, is that if we just think about what's happening in the Middle East, right? Let's think about more recent war, if you will, invasion experiences. This is when Russia invaded Ukraine. It literally was a bottom tick there. Now, the point is not to say that an invasion is bullish, an attack is bullish. That's not the point. Obviously, the market did go on to produce larger downside in here, but let's think about why that took place. Because the Fed was going through the fastest tightening cycle that the market has seen historically. So this fear on the invasion sort of bottom ticked the market. We did see some upside, but then the fundamental valuation of the market is what kicked in a rising interest rate environment to cause further downside. If you think back to the October attacks when Hamas invaded Israel, that was here. You can see a little bit further downside, but then what happens, right? Firm upside. So the point I'm trying to illustrate is that the market context matters far more than what's happening in the news headlines. You're seeing some panic, absolutely, and of course, it's not a good thing for humanity. We're not trying to spin this in like this big, oh my God, it's the greatest. No, absolutely not. But the point is to not get wrapped up in the headlines, and don't forget that the market is a representation of the value of the S&P, at least the top 500 companies in the US. Frame it from this perspective. Does the attack over last Friday, does the escalation fundamentally change the value of, let's say, Apple, Microsoft, NVIDIA, Broadcom, any of those companies? Is the value fundamentally changed there? Seemingly, no. Not yet. So with that, let's drop this down to the daily time scale now that we've at least acknowledged that. Let's throw on our daily set here, and let's take a closer look at what's happening with the weekly expected move, which is where we always start. So expected move is this gray zone right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. What do we see? At the top end of the box, we have 609.85, implying a higher high in the trend count. That, of course, is bullish. However, at the bottom end, you can see we have 584.15 equal lows to these lows from what you could consider a daily balance range back here. Not really all that bullish. So I'd be a little bit more neutral on the expected move this week, noting that we have a higher high, but also a lower low. The reason that I would call this a lower low is because if we were remembering back to the 3-week balance range that we've broken out of, this is the breakout. Here's the test of the top end of the 3-week balance range. Markets basically need to hold up over 595.15 if we're going to remain bullish here, seeking a daily higher low in the trend count. So as I was saying on the weekly time scale, there's really no reason to front run the bearish idea until we actually take out Friday's low. If we take out Friday's low, then sure, game on to at least test this area in here, 585, lower edge of the weekly expected move. The bottom end of the 3-week balance range is a little bit lower than that. It's closing this gap from over here all the way and testing the top end of the China gap. That is down here at 577. So could that bearish thesis be in play? The answer is yes, it could be in play, and the structure does not look good based on Friday's bar. You have an upper wick after the gap down that fails to accept inside of the 3-day balance range from here, rejects that overhead supply and closes where? Underneath, but weak towards the lower third of the daily range from Friday. Now, once again, this kind of leaves us between a rock and a hard place in here. I would not front run the bearish idea until we're firmly under Friday's low on a Brigade bolt here, once again, targeting something like 585. That becomes the first daily play. If you're consolidating here, excuse me, and you get some sort of breakout back over 599.25, which would be a recapture of the bottom end of the 3-day balance range from back here, then I would trade longs into the top end of that range and seek follow through ultimately into the all-time high over time, because this will be a daily higher low in hindsight. We absolutely have fallen into an hourly downtrend in here. Let's take a look at that now. If we zoom in on the hourly, these are all the nuanced levels now applied to the chart. We are in an hourly downtrend, right? You have highs, you have lower highs here, you had lows. This is technically still an hourly higher low, but undoubtedly on the gap down from the Friday session, you produce a lower low. This could also be counted as the next lower high. So long as markets are underneath this zone, right in here, that 3-day balance range, once again, this is kind of your neutral spot. I would really need to see a bullish recovery back over that to get involved back up to the equal highs of the 3-day balance range. And you could start targeting something like 604.30s right around in here. I don't want to get too level happy, but that would be the number. If we get something that looks like this, right? This is where I would be bullish, right? Back on the recapture of this low at 599.25, looking for risk and reward back up into those equal highs, right? Beyond that, we balloon runners towards the all-time high. We have 606.75, and then we have the top edge of the weekly expected move, confluence with a previous level at 610.25. If we're thinking about downside, this is absolutely bearish consolidation because, at least on the hourly time scale, because we are in an hourly downtrend, right? Highs, lower highs, we just went through this. Because we're in an hourly downtrend, in the short term, this consolidation is bearish. If we stay underneath 599.25, the pressure is on from poorly located longs who are trapped overhead to then yield something that looks like this, in which case we start that rotation to the downside we were just talking about on the daily time scale. Ultimately, we want to be targeting this gap down here. However, let's firstly be respectful of 588. That's on a lower high Brigade bolt beneath the top end of the 3-week balance range at 595.15 that we've been talking about. This is a break of last week's weekly bar low. It's a break of Friday's low. So 595.15, this is the executable idea in the downward direction with risk and reward, firstly targeting 588, then looking to balloon some runners towards the lower edge of the weekly expected move and the top end of this gap from over here. That is what we've got on the downswing. Let's talk about what happened on Friday, because I also think that this is somewhat of a tell. Early on in the Friday session, we did open on a gap down, right? We went gap fill reversal, and in theory, sellers had the opportunity to yield a lower high under the opening print and keep things bearish out of the gates. That didn't happen, at least initially. You could see that the market did poke up and into, or I should say above, into Thursday's range, above the bottom end of that 3-day balance range that we were just referencing at 599.25. If you're a stronger buyer, then what you ultimately want to see is, okay, this is just a look below and fail. We hold here, setting up rotations to the upside. Like, let's just say that the daily bar ended up closing like this. I'm just going to superimpose on the hourly. Let's say that Friday's daily candle looked like that. Green-bodied close here, opening print, low of day down here, right? That would have set up longs over Friday's high to get into these equal highs. That obviously didn't happen. So I would say that the buyers actually started to fail here into the afternoon session on Friday. Now, it brings up an interesting point. Does anybody want to go home over the weekend with risk as we have potential further escalations in the Middle East? That probably plays some role here on the breakdown into Friday afternoon, but if we're objectively just looking at where price is relative to levels, being under 599.25 absolutely in the short term on that hourly trend count keeps the bears in control. So down here, bearish consolidation on the hourly. This is what the bears really want to see in terms of daily follow through to the downside. If that fails, I would start to get bullish again on a Brigade bolt recapture over 599.25, seeking the equal high. It brings up a good question where if we open here and look below and fail for something that looks like this, I probably would take a shot at the bullish reversal here as well, noting that we're trying to express some sort of daily high or low. It needs to be a failure pattern first, though. Okay, so if I'm going to entertain this long right here, it needs to break 595.15, and then we need to clearly establish a higher low back above the level. That would then set up risk and reward for a first target here, and then ballooning runners into the equal high of last week, closer to that 605 level that we were just discussing. All right, that is your S&P hourly analysis. That's the game plan. That's the pathing. Let's quickly throw on a couple of Fibonacci's. What we want to do is come from the bottom of the daily level up to the top. This is the last daily high or low, right? Notice that the Fib 38.2 is reinforcing that the top end of the 3-week balance range, which is this box back here, 595.15, is absolutely substantial. It's the Fib 38.2. We could come in from the last higher low pullback, major higher low pullback to here. This is just reinforcing that over the top of 599.25. We probably also get back on the bull side looking for some movement in the upward direction. Let's go ahead and throw on the intraday anchored view apps and see what else we can learn from this perspective here. Great confluence out of 595.15. Once again, I would not jump the gun on the short side. It would require the break and Brigade bolt underneath if we're going to get short there. If we're just supporting over those anchored view apps and then give that look below and fail that we've just outlined, then absolutely we're looking for this long in the upward direction setting that daily high or low. Okay, so that is what we've got from that perspective. Let's quickly take a look at our intramarket internals. There we go. At a loss for words there for a second. Check out the video tutorial in the top right hand corner if you're not familiar with this screen. What do we see? So on Friday, we basically want to gauge the strength of the selling. There was definitely substantial volume outflows on the session. Notice here that the advanced decline line is for the most part near an in-trend lower zone. The index score honestly did not get all that bearish, which is something that I would carry forward here. Just noting once again, it seems more like a panic-driven emotional response rather than a fundamental change in the value of the S&P companies, right? Or a fundamental change in trend on those S&P companies. The biggest, losers out there on Friday really going to be your Apple, right? Apple is one of the heavier weight companies in the S&P, providing some drag, but notably, market conditions were not outright bearish on that Friday session. It was more of a mixed bag. If you look at the cumulative build out of the tick, it absolutely does move in the downward direction, getting substantial at negative 5,000 into the close. So I'm not going to sit here and say that, Friday was, it's a nothing burger, we don't have to worry about it. But I think in the context of everything that we've talked about so far, it strikes me as like emotional hesitation out of the market rather than, oh my God, let's sell the market because there's been a fundamental shift in how we're seeing, the valuations of the company, of the markets develop, right? So to me, headline risk, you could even take a look at this based on the Thursday action, right? Thursday kind of opens lower after the Wednesday drawdown, right? And then rallies and sort of goes sideways all day. Notice the volume inflows they're actually out. They're technically negative there on Thursday, but they're very, very mild is kind of what I'm getting at. Notice that the advanced decline line really, really flat at the zero line. The tick on the cumulative really not all that strong. What I'm trying to illustrate is I don't think it's new money sellers hitting the tape. It seems to me that it's either profit taking or people just, sort of not wanting to commit new money capital up here at the longs. It's a lack of buyers. It's profit taking. It's not new money sellers. That's seemingly to me what the internals dashboard would illustrate here. Let's quickly check in on the market profile for the ES. If you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. What do we care about here? There's been a fundamental shift basically in the market profile where we see that value is here, value is here. Here's the Wednesday session, value continues higher. Thursday value is inside of the value area from Wednesday. Notice that on the Friday session, value breaks clean to the downside, stopping the trend of value moving higher. Now, it doesn't strike me as, again, the end of the world, because if you think about where ultimately the market was trading through the overnight session when the peak sort of fear, if you will, from the escalations were taking place, value is still overlapping to up on that. Even if you take out, let's just draw all of these. It's really, it's kind of wild to say, but you could think of all of this as equal lows. There's that 3-day balance range, 4-day balance range, if you will, from earlier in the week. Value still overlaps that a little bit, but it is lower. So the point I'm trying to illustrate once again is that you could have trapped overhead supply from in here, which makes it a little difficult for the market to catch a bid from. And value does move lower. Point of control does move lower with price on that Friday session, confirming just a little bit more sell side as opposed to buy side, right? It'd be a different story if value was overlapping to up on all of this. Like, if this was the value area shaded yellow, that would be a totally different picture. And we'd be saying, okay, great, we're going to be looking for upside early next week. Value does shift lower. So is the market caught between that rock and a hard place? It does seem like that to me. The last thing I'll sort of point out here on the market profile is the poor high from the Friday session. Notice the E and F periods back to back. This also lacks material excess here. This is a poor high on the Wednesday session. The Wednesday session is probably the most important. If I scrunch this up, I think, yeah, there we go. Look at this. So we know that CPI is what came out Wednesday morning and pushed to the newest highest high in the trend count there. And then the market, the regular trading hours high was technically below that. So I would carry forward the CPI high as a reference much closer to 60.75 in the ES futures. That number's likely going to change this week. We do have futures rolling on is it Thursday? No, Friday. They're going to be rolling all week. The contract volume will be rolling, but futures expire on the 20th. Okay, we will have to move to the next contract here for the good old ES. So this number will change, but carry forward the CPI high. It is what I would consider unfinished business, right? The market really should test that in the regular trading hours, confirm either yes, rejection, or no acceptance, and then move from there. So the fact that it was untested leaves me a little bit hesitant about the rally being over, so to speak. However, the more pressing priority is absolutely that value is lower. Let's get back on over to the platform here. Let's take a look at our good friend, the nasty NASDAQ, and see what we've got from this point of view. Weekly time scale. Let's jump it on up. Let's go with the clean drawing set, and here we go. So what do we have on the NAS? You can certainly see the same exact structure in terms of the weekly bar. You've got your red bearish inverted hammer. Close is, of course, underneath the opening print. So same concepts. Buyers failed, sellers stepped up, or just profit taking. That's really the lens I would frame it through. Closing inside the previous week's range. Where are we relative to this balance? We're still above the top end. There's still plenty of room for a higher low on the weekly, noting that we have higher highs and higher highs happening here. If you do pull back into the range, the bottom end will be the target, and that is still an opportunity for a weekly higher low, noting that the trend is lows, higher lows, and it's very possible you could easily set a major higher low even all the way down towards the China gap close, as we've said in the S&P. No change in terms of the QQQ structure. What else is going on here from a fib perspective? There's really not much. It's not groundbreaking. It's going to be very similar. Fib 38.2 is sort of just a hair below the China gap close, reinforcing that is a bullish spot for a higher low. Very similar coming in from the all-time high, Fib 61.8. It's going to be right there as well. So no change out of that. If we take a look at the anchored VWAPs on the QQQ above the entirety of the stack, and once again, confluence with the China gap close is still a top priority. If the weekly gets more aggressive in the downward direction, I would still be thinking about higher time frame, higher lows. Let's zoom out and take a look at our high volume node because, I think we threw on the wrong study there. Let's go volume profile weekly. There we go. We know it's one major node instead of multiple like what we have in the S&P, and that's still along the lines of the same area. Still thinking about weekly higher low structure, preserving the higher time frame trend in the upward direction. Notice this volume node, the bottom end of what I would consider the zone above, is kind of the midpoint of the 3-week balance range out of the NASDAQ. So let's just be a little bit more mindful of that, where if we do start breaking down towards the lower third of the 3-week range, so what does that mean, right? Something that looks like this. If you see that price action is hanging out down here, I would be very open-minded to the gap closing all the way, right? Rather than if the market comes into the 3-week range, comes into the high volume node, bounces and stays above in the upper 50%. You don't have to be, don't split hairs on this. Just 50%, fine, top or bottom. If you're in the upper 50%, you're staying over the high volume node, I would be less inclined to be thinking about the potential China gap close to the downside. Let's take a look at the daily time scale here out of the QQQ NASDAQ. Let's go with our daily drawing set, a little bit more simplified. You guys can let me know in the comment section as well if you've been enjoying the simplified daily look before we get into the nuanced hourly look. It sort of makes it easier for anybody who's operating on a higher time frame, really. Anyhow, what do we see here on the QQQ? First things first, we've known that there's a subtle divergence between the Qs and the S&P, right? We broke out of the balance range back here a little bit more aggressively. This higher low pullback held the 522.50s. But then the S&P continued to grind over the Thursday high of now 2 weeks ago, whereas the NASDAQ could never really find much acceptance over that 533. So on the Friday breakdown of this week, it's actually much more of a clean gap fill reversal underneath the Thursday low and a rejection of this previous Thursday high from way back over here, which leads me to believe that the NASDAQ could lead the S&P slightly lower as and if we get a test of that 522.50 again. If we break the low of Friday on the NASDAQ in particular, I would be looking for the follow through to at least here. And, that's not a huge range to be trading for, but what it likely does is it probably pressures the S&P 500 underneath its key daily level as well. If we just quickly flip back over here, that would be underneath the 595.15 if we recall, right? Let's just zoom in on this for a second to make sure everybody's on the same page. If the NASDAQ is breaking its low, the S&P is probably breaking its low and pushing it into the 3-week balance range from back over here, 595.15. The issue with the market ultimately is if the NASDAQ tries to catch itself for a higher low over this key level, 522.50, I'm going to have to maintain the stance that I've expressed over the last couple of videos where even if the S&P breaks underneath that key level, it's going to be very, very difficult for me to take a bearish stance there if the NASDAQ is supportive over 522.50. I just don't see the reason as to why the NASDAQ would not attempt to hold some sort of daily higher low in the trend count here after pulling back from the highest high in the trend count, right? It'd be very difficult. Like, I think we talked about this in Wednesday's episode, right? The actionable takeaway here is that you do not want to be short into areas of support in an uptrend when the market's pulling back. You want to be closing shorts here, and you want to be looking for opportunities to get long. So in the intro, when I say, is it a great opportunity to buy the dip ahead of the FOMC? It's possible. It certainly seems to me like the bullish base case is absolutely the primary thing to be looking for, which is that higher low here in the NASDAQ. If the S&P just says, you know what, let's turn around right here, that 595 level, if we stay above that, it's a great higher low. I would much more be open-minded to the opportunity to continue trading the trend in the upward direction. If we pull back, we'll have to adjust, right? But I really don't think that there's any big overwhelming bearish evidence as of right now. So that is what I've got for you, excuse me, in the QQQ daily. Let's take a look at the hourly, see what else we can learn from the price action here. Very clean gap fill reversal. Once again, that is your Thursday low ultimately. Price action was unable to accept inside of the Thursday range. We close weak. What does that mean? The hourly trend is flipping to down, lower highs here. Really more like equal lows here, and then finally a lower low via the gap down on Friday. So the hourly trend is down, which means if we pull back to here, it's finally a firm higher low, because I would not really call this a firm higher low on the daily. This is not an hourly downtrend. It's like 1 day's worth of panic where the Tesla and Musk-Trump drama was taking place. This is finally an hourly pullback, hourly downtrend, I should say, which means that the daily can set that firm higher low. I'm still open-minded to, once again, I think everything adds up here basically to still maintaining the bullish base case, looking for the higher low. There's no break of key structure yet that is so dramatic where I would have to say, okay, let's reevaluate everything and start looking for more downside. I think you could easily get a little bit of one of these. Let's say we open inside of Friday's range on Monday, something that looks like this. Absolutely, maybe there's a scalp to the downside for this intraday. But when we get to 522.50, I would more so be open-minded to, how do we get this? Trade back in the upward direction. I would certainly have to retarget this as a primary inflection point, and then beyond that, 533, absolutely. But if you could establish the risk-reward location off of these lows, that's really the most lucrative spot to do it. So 522.50 in your QQQ NASDAQ. Let's quickly come in with the Fibonacci's and see where we land relative to this. Up to the high, Fib 38.2 is kind of close to Friday's lows, actually. It's not aligned beautifully with the structure. I would definitely prefer to watch for the 522.50 rather than the arbitrary fib there. It's coming from this low to the high, and what we can see here is the fib 61.8, just reinforcing the line in the sand. So that one's a little bit better, and once again, this actually is an hourly downtrend here. You open on a higher high, this is a lower high, these are lows, these are undoubtedly lower lows, right? So this is an hourly downtrend, this is kind of a higher low, which means that this Fibonacci, once again, aligning with the fib 61.8, 522.50, strikes me as being a little bit more important, a little bit more confluence in terms of confidence building at that potential level, right? That is what we have there. Let's take a look at the intraday anchored VWAPs. Notice that the spread here is kind of engulfing, if you will, the 522.50 mark, as opposed to the ES and the S&P 500, which is still underneath. So we'll watch out for that. In this zone, things could just, I would be more so bullish looking for upside reversals there rather than bearish coming into the anchored VWAPs. We didn't really talk too much about it in the S&P, but if you anchor a VWAP to the top of this move, Wednesday basically, on the gap up from CPI, one of the easiest, hurdles or ways you would say, okay, let's really start to put the pedal to the metal on the long side again, is if you can get back above that, now everybody's happy again. So your Brigade bolt over 533, of course, should start to target the all-time high here out of the NASDAQ on the QQQ. So we didn't really talk much about that as a situation. We talked much more about the pullback in here. However, if the market just rallies and accepts over, let me clean this back up to a cleaner instance of the Qs, please. Just that way we're not dealing with all those anchored VWAPs and lines. If we get consolidation here and then here, you're sort of really stuck in a range. Like, this is not a very lucrative spot to be trading the market, I feel. Like, if you look left, really, really tough action in there. The best outcomes are probably a break of the anchored VWAP that we just had from the high here, like this. Brigade bolt over 533 to target the all-time high. That sort of establishes a higher low on the daily time scale. You did not get underneath your 522.50, and a break, you could even probably draw this as a trend line at this point. A break of the trend line just sort of treats this all as a daily bull flag up here towards the highs. So that's kind of where I'm at on the QQQ and the S&P combo. Let's take a look at the NASDAQ market internals. You can see here much more substantial volume outflows on Friday, below trend lower zone on Friday, and the cumulative build is pretty horrific out of the NASDAQ there. In terms of where the market actually went, I still find it to be, this is not aggressive new money selling in the context of where the market actually went, right? Aggressive new money selling would not have allowed for that first rally in the upward direction in the first place. The gap wouldn't have closed. It would have been gap and go. It would have been, oh my God, markets are, testing and taking out the overnight low. Here's another easy way to just gauge, like, okay, how strong really were the sellers on Friday? Well, not that strong, because if you just bring out the overnight low from the NQ, we didn't even come close, right? On the intraday, regular trading hour session. Now, it's not to say that we can't get there early this week, but once again, as I'm evaluating the internals context with what we got on Friday, doesn't strike me as new money sellers. It seems like either profit taking or just longs who are not interested in allocating capital up here towards these highs. With that, let's go ahead and take a look at the market profile for the NQ and see what's happening from this perspective. Going to have to do some funky zoom in here. And let's get that centered on the screen. So same concepts as I just go like this. There you go. There is your CPI overnight high. It was not tested in the regular trading hours, so carry that forward out of your NQ as well. Same, actually different commentary. Notice on the NQ, if we do something that looks like this kind of marks off the bottom end of the multi-day range, if you will, where value is pretty much unchanged. Here's value, here's value, here's value slightly higher. It's back a little bit lower. Value's unchanged in this box, right? Well, look at the value area from the NQ on Friday. It's actually split 50-50. Another reason to just say, once again, it doesn't strike me as new money sellers getting overly aggressive. You should, in theory, have value area that was cleanly underneath these previous lows, if you wanted to just use that as a delimiter of price. So with that, I would still maintain kind of that more optimistic stance here. I think if stronger sellers, could shift value lower, we'd have a different tone right now, but it just wasn't the case. You can see the point of control is actually over half back, which is the purple line on this screen. You do have a poor low. You do have a lack of material excess at the high, lack of material excess at the high, lack of material excess at the high. All of these auctions on the lows from Monday, Tuesday, Wednesday, even Thursday do look to have decent excess. Those seem secure to me, but these auctions on the highs, kind of some unfinished business towards the highs on the NQ. Another sign to just be like, okay, let's say we open weak, we sweep the low, come back above, or we support above. We know it's the 525 plus or minus 5 level on the NQ futures. Let's say we come in for a test of that to repair this poor low back inside of Friday's range. I think it's rock and roll back up to the highs to repair the unfinished business that we have up here ultimately, and don't forget also the CPI high as well. With that, let's get back over to the platform. Let's finish up our broad market with our good friend, the IWM Russell 2000 and the small caps. With the weekly time scale up first, a little bit more damage being done over here on the Rusty Russell. What you'll notice is a firm rejection of that weekly 50. So let's not deviate too much. Let's stick with candle structure and location. In terms of structure, solid red-bodied bar, a little bit of an upper wick indicating some sell side towards that 50 once again. The biggest concern is that this does break back down underneath what I would consider the neckline, so to speak, of the higher time frame inverted head and shoulders. Right, this is kind of what we've been tracking over the last little bit. It's a daily breakout level. It's actually an hourly inverted head and shoulders in here as well. There's just nothing really constructive about this getting follow through in the upward direction via the close that's really weak as of Friday. So, you could do something that looks like this as well. You're rejecting this previous pivot low, what was once support, now acting as resistance. You're still technically in a little bit more of a troublesome trend here on the IWM small caps, noting that we have highs, lower highs. Could this be a monthly lower high? Probably not a weekly, right? Because the weekly still goes lows, higher lows, highs, equal / slightly higher highs. This is a higher high. So you are technically trying to develop a new weekly uptrend, but undoubtedly, and unlike the S&P and the NASDAQ, you're just not even close to the all-time high. You still have the threat of a monthly downtrend happening here, especially noting that this is a massive monthly lower low underneath all of this that was happening up above. So the point stands. There's definitely more weakness in the small caps, especially noting the candle structure. You do still have location-wise higher high and higher low. Closes much more firmly in the midpoint of the previous week's range versus the S&P and the NASDAQ towards the upper third of the previous week's range. Let's start with the Fibonacci's just to check in on how deep this pullback ultimately is. Still well above the Fib 38.2, confluence with the weekly 200 SMA, which keep in mind is confluence with our 200 figure. If we just zoom out on the weekly time scale, let me grab like 5 years of data to look at. Everybody's on the same page here. That's kind of your key. So although I'm not fond of the failure of this breakout from the inverted head and shoulders, I still find it very difficult to get aggressively bearish quite yet on small caps if we're above this 198-200 zone. If we're above that, then you can sort of see how it's possible the the small caps looked into the range, quickly failed back out of it, sellers failed, and now if we can stay above, can we build something constructive back in the upward direction is the next major question. So looking out for that out of smalls, if we come in from the top to the bottom from the fib perspective, a rejection of the fib 61.8, so not getting follow through for the 100% retracement, not spending any time over the fib 61.8. What about from this perspective here? Pull back to the 61.8. If we could stay above, then maybe there's an argument to be made that there's a reattempt of the 50, but for now it sort of seems more like the small caps are not quite ready given the size of the rejection here relative to what we see over in the S&P and the NASDAQ, especially noting that a majority of companies in, you could say, small cap land these days, small energy companies, banks, some healthcare stuff, energy was obviously up and away with crude massively higher on Friday. So to see some relative weakness here on smalls is not all that compelling. Let's take a look at the anchored view apps from the keep messing up NASDAQ and Russell. I don't know how, but where are we? We're still at the top end of the stack, so we'll see if that can act as a little bit of support. The read on the Russell, honestly, and you can probably hear it in my voice as I just talk myself through this, the read on the Russell is a little bit trickier. Like it's kind of at a do or die spot. You either have to hold here and fine, it remains constructive, or if it starts to break down a little bit more, we're just kind of back in that uncomfortable zone where I don't think nobody's really participating in the small caps in this sort of zone in here. And you would require more information basically to get a read on it. Let's take a look at the volume profile. We're underneath the highest volume node coming from way back over here. This top end of the high volume node is somewhat supportive. The bottom end, this is kind of that no man's land that we were just saying is kind of ugly and no one's really participating there. So if we could stay over this, maybe we'll give the Russell a small benefit of the doubt. Let's go down to our dailies. Let's take a look at the expected move, not the clean drawing set, the daily drawing set. There we go. Upper edge, lower edge, what do we see happening here? 215.44 and 202.25 on the IWM. Notice again the failure of the breakout from this as an inverted head and shoulders. Your neckline was here, labeled beautifully 209.75. Inverted hammer on Friday, closing week below. In theory, the best outcome for buyers would have been this to then get follow through in the upward direction, staying over that 209.75. Not the case. You could also see how it was this, the right shoulder of the major inverted head and shoulders is an inverted head and shoulders itself. So two failures, if you will, on that front. Gap fill reversal was perfect on the Friday session. Let's zoom in a little further on that. You can see here, perfect gap fill reversal. Not once was there any attempt for acceptance inside of that Thursday range. A little bit more bearish here out of small caps as we get down through and into the smaller time frames. The more time that's spent now underneath 209.75, the more I would expect the rotation down into these lows at the 203. Remember that this zone in here is that major spot on the weekly time frame from the previous balance range. Let's zoom back out on this and let's actually just go straight down to the hourly time scale. What can we read from this perspective? I think it's very straightforward. You have a rejection of your daily 200. You're firmly in an hourly downtrend, and that hourly downtrend is not trying to find any reversal at the neckline yet. The only way in which this would become compelling is if early on in the week, you immediately get a rally back over 209.75, pull back, find a higher low. What have I just drawn? You have left, you have head, you have possibility for a right shoulder. That is a very nuanced, probably something like a 15-minute inverted head and shoulders that could cause the hold of the 209.75. It's an optimistic take, and obviously the close is weak so far underneath, but that is the thing that you would want to be watching out for, especially as a potential bullish pressure for the S&P 500. So that's probably a top priority, as in a top watch early on in the week for smalls. If Jerome Powell comes out and says, you know what, we're going to start hiking rates again, expect this to do this, sayonara, you're probably underneath your weekly zone here around that 206 to 203, 190. It's here. It's 203 to 198, this zone in here. So that is the downside watch. I don't think Powell is going to say that, but we've got Wednesday to figure it all out. We will be live up in the office on Wednesday we'll probably kick things off at 1:45. We'll fire up the live stream and see what Jerome Powell has for us for the actual decision, as well as, more importantly, the press conference where we can read between the lines. That's it. That's all we've got on small caps. So if we get the rally rejection, again, thinking about downside, if this early week reversal holds, great, helpful for the S&P. Let's go ahead and we'll be congruent. We'll take a look through the lens of the fib from the low up to the high. 38.2 on the money. You can't make this stuff up right at the 209.75. If we can get back above, fine, the bullish consolidation persists. If not, a little bit more troublesome. If we come in from this up to this, 50% retracement right on the money there. Not much else that I would overly index on. And we can come in here with the anchored VWAPs intraday right at these. Again, if we do hold, it's possible that you get here, if you're really waiting for that next signal, a break of the anchored VWAP from the highest high in this trend count could be your next signal on the long side to at least start pressuring the S&P more so in the upward direction. Let's quickly check in on the Russell internals, and we'll see what's happening over here. Volume outflow is not that bad. In-trend lower zone, near-trend lower zone for most of the day. Bearish build on the cumulative, and to me it seems similar to the fact that we're not really seeing aggressive downside selling come in here. It seems more like profit taking. Why would I make that claim here in the Russell in particular? Well, because the trend is more severe on the hourly, right? We know that we have this big rejection of the daily 200. We saw downside, we saw downside, we saw downside on Friday. What are the market internals actually doing on Wednesday, Thursday, right? I mean, I'm not going to sit here and say that they're bullish, but are they pegged down below in trend lower zone Wednesday and Thursday? No. We opened positive and we failed. We opened lower and we rallied, right, out of the advanced decliner. You can see the same thing on the volume flows, right? They're really mild. They're not like big volume outflows. And the same thing with the cumulative build. It's a mild bearish cumulative build. Thursday's completely flat. It doesn't strike me as aggressive new money selling. It's just a lack of willingness to participate on the long side up there, which just means obviously the market's got nowhere to go but either sideways to down. So if this changes, if we start to see more aggressive follow through on the sell side, I'll certainly call that out, but not seeing it as of right now. Let's quickly check in on our Rusty Russell market profile, see what's happening from this perspective. Of course, similar commentary to everything else thus far. Here's your CPI high. It's much higher than what we have in the NASDAQ and the S&P, so carry that forward as weak and probably needing some sort of test, some sort of repair. You do have, if we zoom like this, on Wednesday, value already shifted lower in the individual session. Point of control was lower than Tuesday. Here's your value lower on Thursday. Values undoubtedly lower on the Friday session as well. You do have a poor low and a lack of material excess on the high and low. Maybe a decent excess on the high actually from the Friday session as we zoom in there a little bit better. However, what this might imply, right, is that we open fairly weak. We sweep that low. If we can come back above and sort of stabilize over the pullback level in the Russell, we repair the structure, stabilize above, maybe the buyers have a second shot at holding the retest, that Brigade bolt ultimately over that daily level. If we're talking about the IWM, that's that 209.75 that we've been talking about so far. All right, enough about small caps, everybody's least favorite little tiny second removed cousin of the market. Let's get into the S&P sectors. Let's see what's going on over here. In terms of weekly performance, who was leading, who was losing, and where was the weight? Energy undoubtedly leads the pack, primarily from the Friday session, of course, up 5.21% on the week. Friday looks flat here, but obviously it was a large gap up. TLT is leading the pack as well, up 1.52%. Then we have healthcare, 1.32%. That's a pretty defensive look towards the top of the list. Just below, though, is the semiconductors ETF. Then we get utilities right back to defensive, real estate, hard assets right back to defensive. At the bottom end of the barrel, the laggard of the week is absolutely financials, down 2.69%, followed by industrials, communications, and then staples. The tech sector, it's pretty flat. It's only down about 5 basis points on the week, really unchanged there, and for the most part, as we'll see on the structure in just a second, hanging out near the all-time high. If we look at XLE for energy, this is that big gap up I was talking about. So the performance on the week is absolutely green, and when energy outperforms the S&P, typically you are looking for a little bit of a pullback there for a number of reasons, right? Obviously, you have energy correlated to the interest rates to some degree, dollar to some degree. Outperformance from energy is not typically a big boon for the S&P 500. Also, outperformance here could start to indicate subtle, please don't misinterpret this, subtle inflationary pressure, right, as energy. And if you just look at crude, right, as a proxy for just energy expenses, just literally almost off the charts after starting to break out from this inverted head and shoulders, really accelerating, obviously, on the tensions over in the Middle East. So as that's taking place, inflationary pressures, I think it's, and you'll probably hear Jerome Powell reference this perhaps in the commentary on Wednesday, it's just going to be a one-time, sort of shock here to pricing. I don't think necessarily that we're going to persist with oil that starts rallying. Let's not get too crazy here, but let's just go out to a weekly chart. You're probably not talking about oil up around, over the $100 barrel mark. That would be definitely cause for concern on the inflationary front. Seems to me like it's sort of coming into an equilibrium spot, actually, much closer to this area here. If you were to just treat this as a range, that's almost the midpoint, okay? So that is energy. I think it's slightly inflationary as a one-time shock, but not enough to really send the market out of control here. Let's quickly jump into the TLT. We'll just go through the list in order. There's nothing to write home about here. You're getting consolidation. I'd love to rinse and repeat the sale of puts on the TLT. Let's just say that Powell says something that sends the bond market lower. If we get some sort of gap down, if we're dealing with some sort of improved implied volatility, maybe some put sales down around the 80 handle again, but for now, there's really nothing to do here in treasuries. The one thing that I do find somewhat interesting is, although they did outperform the S&P slightly on, not slightly on, they outperformed a decent clip on the week, I would have expected a further outperformance here, like some really specifically on the Friday session, much more of a, quote, flight to safety taking place as the tensions are arising in the Middle East. They didn't really see that. I mean, honestly, the TLT, the bond market here, actually gapped down underneath. It's not a true gap. It's still inside of Thursday's range, but you open lower, right? And there's this test lower. It's not like people were going out there and buying bonds with both hands. There was no sell the S&P, buy the TLT on Friday in particular. You can actually see on Friday, the bonds were down about 46 basis points here versus the S&P down about 25 basis points. So the S&P outperformed on that Friday session. So the flight to safety is just not really, it's not shaping up if we're looking at the TLT. Healthcare is continuing to grind towards the top end of its range. Remember that this is bullish for the rotation in the S&P 500. We'll continue to monitor that. As long as it's not breaking down and making some sort of new lower low underneath 129.25, no issues there. Semiconductors ETF pulling back on the Friday session, but once again, we talked about this on Wednesday. Is there any cause for concern here? I mean, this should be a top priority. Do we get the pullback to 249? Do we support over previous resistance, offer a higher low, and then get follow through in the upward direction? That should be absolutely a top priority out of semiconductors, which would keep the broad market bullish and maintain the bullish base case. So going back to maybe the question from the intro, this has to align with the bull thesis still. If we look at utilities, it's a D for defensive sector. It's kind of sideways in here. Utilities have been really just caught between two large trading ranges. If we're in the upper one, maybe it's bullish pressure for the market. There's no relative outperformance with this massive push to new all-time highs. It's not leading the market higher. I'm not overly concerned with it. If we look at real estate, it's the same comment over here. Although it's technically green on the week and the S&P is technically red on the week, it's not moving in a way where I'm overly concerned about hard assets outperforming. We'll look at gold here in a second as well. It doesn't strike me as flight to safety or risk off, right? If we look at the XLY, it's inside of a balance range. I definitely don't like the Friday bar, the Thursday bar either, is just sort of rejecting that Wednesday low. So we'll treat this as maybe a little bit more bearish headed into the week, being in the lower 50% of the range here, rejecting that in the upper wick. But unless it's actually closing the gap from the China move to the upside, I don't think there's an actionable short here. As a matter of fact, if you're just a range trader, until proven otherwise, you should be looking for longs here and shorts here, right? That's just classic balance rules. Buy the bottom, sell the top, right? Until we actually get a break and hold underneath Brigade Bolt, that's where we actually get some directional activity. So XLY, neutral until proven otherwise. If we look at financials, this is where there's a little bit more of a concern. Financials did yield some sort of lower high. They never made it quite to the equal high, and now they're testing that neckline as of Friday. So if this is sort of like daily or even weekly double top, any starts or any beginning breakdowns of 49.75, I would think easily come back down towards the key moving averages here, as well as what was ultimately the top end of the tariff turmoil zone here as kind of a literally just that zone, if you will. So 48.65. All right, so financials are a little bit of a red flag. They're definitely something to pay attention to early on in the week, depending on what Powell says for us too. If interest rates are going to stay higher for longer, maybe financials like that and catch a little bit of a bid back here into this sideways range. If they could neutralize and make an equal high instead of leaving this lower high, that would start to get me a little bit more neutral on financials, and ultimately it would start to play out as a weekly bull flag. Of course, bull flag probably resolves in the upward direction if the weekly trend is going to persist. Let's take a look at industrials. New all-time high earlier on in the week, or actually into the end of last week, and just a mild pullback. So not overly concerned with this. A little bit of look above and fail, perhaps. If it pulls back to the low end of the range, maybe again the S&P stalls out a little bit here. Maybe we rotate to the bottom end of the S&P 3-week. balance range there, but not a doom and gloom, oh my goodness, massive reversal across the market. If we look at communications, great spot for a potential higher low right here, retesting the top end of the range. So Brigade Bolt, looking for some buyers to step up. The only issue is that Friday's bar is not all that compelling. 102.25 needs to start finding buyers here. So look below and fail, higher lows back above, something that looks like this, right? That could be in play. If you open inside of that Friday range and start to move over Friday's high, that would really put the pressure on any shorts who got short directly into support. That's, again, in an uptrend, horrible, horrible idea. Why would you be shorting directly into a potential area of support? Not the name of the game. And that's really what we continue to do in the S&P, right? We're not shorting supports, and we're looking for very cautious longs as and if long setups develop. If we look at the XLP, there's no comment. We're in the midpoint of the range. It has not gotten in gear here, so not much to say in terms of bullish or bearish pressure. XLB materials not really doing much, just a mild pullback back into this range after making a higher high. I think more importantly, we can continue to watch the XHB for home builders, and just like we're not jumping the gun on these breakdowns, we're not jumping the gun on the reversal here, but the weekly double bottom, the higher low, if it can persist, which again, Friday's action does not look great. Notice the move back down to here. You could certainly build the argument that you have a daily lower high. If you like, you could call this a daily double top. So if the home builders are going to confirm new all-time highs for the S&P, you'd probably need to see it look like this. If we're going to start to fall into a little bit more turmoil and wishy-washy action for the S&P, a breakdown underneath this neckline, which obviously based on Friday's action could be more of the reasonable outcome here, something that breaks there probably puts the brakes on any S&P rally into the all-time high just yet. So that's sort of a top watch as opposed to materials. The home builders, in my view, going to be a little bit more influential. If we look at the XLK, saving the best for last, new all-time high close on that Thursday session. Beautiful. As the top dog, heaviest weight sector in the S&P. Look at this chart. Ask yourself the question, is there anything bearish here where, oh my goodness, we should short the market into the ground with both hands? No. We made a new all-time high. We pulled back. If we can set a higher low over 235.75, let's rock and roll. We're riding on for a higher low, and then we look for follow through in the upward direction over 242. And as a matter of fact, because I know someone might call it out in the comments, we were technically off of the all-time high by 1 penny. What I want you to do is look at the little, if you look at the box right here, it says H, that stands for high. As I hover my cursor there, 243.13, this high back here, 243.14, off by 1 penny on that Thursday session. Incredible. Anyhow, it's not bearish. We'll frame it that way. Let's move along into our ratio grid and see what's going on with the sector ratios. If you're not familiar with this type of chart setup and how to do it in Thinkorswim, check out the video tutorial in the top right-hand corner. Risk on, absolutely. This could use some improvement. This is defensive sector. This is a troublesome spot for the market. So once again, does it look like we have big new money sellers hitting the tape? Oh my God, risk off is the prevailing look. No, but risk on is absolutely slowing down. If we look to these two boxes down here, I think we can clearly see the illustration that it's not risk off. If it was risk off, like duck and cover, go hide and pull all your money out of the market, you'd be seeing outperformance from staples, you'd be seeing massive outperformance from utilities. We're just not seeing that. You could see this as illustrated from the risk on off A set. Still looks good here. Still looks good here, holding in there sideways. This looks great for a higher low, higher low, higher low here, higher low here. Speaking of this chart, the ARC-K, take a look at that in price action by itself. In isolation, look at the Friday session. So huge rally in the upward direction, actually closing inside of the Thursday range, unlike the S&P and the NASDAQ, which rallied, rejected, and then closed weak. So in terms of risk on, risk off, you've got a breakout here, relative strength on Friday when the broad market was weak. It does not strike me once again that we have huge new money sellers. Oh my God, sell everything. The market's going to tank and it's going to get ugly, right? These risk on assets would be underperforming if that was the case. Everybody would, yeah, of course, we're going to rotate into defensives. What the heck are you talking about? We're still long ARC-K. That's not the environment you're going to get when, it's time to duck and cover and oh my goodness, markets are going to go to zero. If we move back over to the risk on off B set, you can see here that gold slightly outperformed. We'll take a look at the actual structural chart in just a second. Bitcoin is stable inside of this sort of flag range up here, but we do have a red signal out of the Sailor Shift tool, and the TLT ratio to the S&P just kind of still sitting sideways on these lows, not really indicating any major flight to safety. Let's go ahead and take a look at gold. Before we take a look at currencies, you could say gold is expressed as a currency, that's fine. You sort of have a trend line break here in the upward direction out of gold. So I think paired with the catalyst of what was taking place, obviously Thursday night into Friday afternoon, any potential continued escalation over the weekend, the safe haven asset gold is definitely performing better than the TLT. So I would use that as a signal. I think gold is acting a little bit more like a trade for a lot of folks versus full-blown flight to safety. Oh my God, let's sell S&Ps and get into treasuries. We didn't see that, right? And I can just bring that up in a full screen pane as well. If we look down here at this, right, on the Friday session, there's really nothing. This is going to get a little skewed because it measures from the prior day's close, but there was not massive outperformance from the TLT relative to the S&P 500. So, and look at these lines. Thinkorswim's breaking. It doesn't like my adjustments. Not really a huge flight to safety. To me, this combination of data points, gold and the bond market, is telling me that it's a one-time emotional shock, not a structural issue where, oh my goodness, let's panic out of everything and sell it all. All right, so that's kind of the crux of the investigation from today's session. Let's look at the dollar and rates. Oh, Thinkorswim, is it going to lag up and is it going to lock up on me? It very well could. Let's take a look. Can we reset this perhaps? Any love? No love. No love. All right, we'll give that one moment as it thinks perhaps in the background. And in the meantime, we will jump on over to, let's take a look at the Fed Watch tool. So Fed Watch tool is telling us that we've got 99.6% odds of a pause in the upcoming meeting, which is, to be expected. We know that the labor report came in better than expected on the, not this previous week's trade, but the week before that. Inflation came in way better than expected on both the CPI and the PPI front, and therefore, right, the Fed's probably not in a rush to either cut rates aggressively because of the state of the labor market, but they're also not really, there's no need to hike rates if inflation's remaining quite tame. The one thing that we'll continue to sort of reference here in the videos is the real rate from the Fed, right? And if we just take a look, this is the last SEP from the Fed, Summary of Economic Projections. We do get a new one on this Wednesday's session. What we care about is the PCE inflation forecast right here and the Fed funds forecast. This is the longer run column. If you take a look, the Fed funds rate at 3% and the PCE inflation rate of 2%, not to insult anybody's intelligence, but 3 minus 2 gives us a real Fed funds rate of about 1%. So if the Fed is trying to reach neutral, 1% is what we're looking for. Obviously, if you take a look at what's happening here with their forecast for 2025, 2.7 on PCE, 3.9 on Fed funds rate, they're sort of still restrictive at a 1.2 real rate from the Fed. So we'll see how these numbers shift on the Wednesday update. We will be streaming it live. We'll sort of parse this out in real time as the market's responding. We can look at price action. We'll see whether or not the bond market is freaking out. We'll see if there's any trades that could fire off as this is taking place. So feel free, come on out to the show on Wednesday. We'll kick it off at 1:45. If we take a look back at the, let's go here for the calendar. Retail sales kick us off earlier on in the week. That is Tuesday, 8:30, so be prepared for that. Empire State Manufacturing, kind of a nothing burger on the Monday morning session. And then Wednesday, of course, it looks like actually they're bumping. This is why. So we know that we have the Juneteenth holiday. Markets will officially be closed. You can double check it on the NYSE website. They do have market closure there. So June 19th, markets are closed. Don't expect much to be going on there. Maybe a shortened futures session. I did not check the CME website. However, Wednesday, we're going to get bumped up to unemployment claims, and then 2 o'clock is the major release of the SEP. That's that document we were just looking at. And then the press conference from Jerome Powell will be fairly telling. That's where we'll need to read between the lines up here in the office and sort of get the job done looking at intraday market volatility. So, sort of an interesting week with the Fed meeting and then straight into a holiday. Friday looks to be pretty quiet here as well. I actually did not look intraday at the 10 o'clock. What did we get here? Consumer sentiment, strong rebound, as well as inflation expectations moving in the downward direction. That's a positive development here out of the University of Michigan study. So just carrying that forward as well. But in terms of forward looking, it's all about the Fed funds. All about the Fed funds here Wednesday at 2 and 2:30. All right, let's take a look at the earnings calendar. What's going on from this perspective? Really not much. Perhaps a little bit of something from Kroger. That's really it. I don't think, maybe Lennar Home Builders over here give us a little bit of insight as well. Aside from that, really nothing on the calendar. We know it's the end of the earnings season anyhow. Let's flip back over to the platform. With any luck, are we able to load anything, or is Thinkorswim SOL? Looking like we might be SOL. Let's take a look at bonds relative to themselves. Can we get anything here? No. How about if we go back over here? Let's give this a little reset. This is working fine. Let's quickly double check this. If not, folks, I'll be back with a look through some of this later. Okay. Instead, what we'll do is we'll move into the core list of companies. NVIDIA is going to be first up on the chopping block. And what do we see over here out of NVIDIA? If you want this, summary, by the way, of what's happening, bonds are a non-issue. I just actually, I know this stuff off the top of my head. Bonds are a non-issue. Credit spreads are a non-issue, moving in the downward direction. If you take a look at HYG in isolation, it's going to be an equal high instead of the S&P breaking to that higher high. So this is still confirming the neutrality. The one thing that you can watch out for is the LQD, folks. LQD just made a higher high. So no issues out of corporate grade credit. Junk bonds, on the other hand, the HYG, a little bit more neutral. If you were to look at total breadth, this is actually a concern. We do still see the divergence out of stocks over their 50 SMA and 200 SMA, and we actually did see a negative impression out of new highs versus lows as we finished out the week. The most important thing that I really wanted to show you, RSP is definitely still divergent from the bearish sense. And I know I'm doing this from memory and you don't have a visual here. Maybe I'll bring in some screenshots from other stuff as I'm doing it. QQQE is divergent from the weighted, which is something that we have not seen in a very long time. Please carry that forward as a data point. And then also I wanted to, of course, talk about volatility. VVIX is up and away like a rocket ship. And if we take a look at volatility futures, although we can't see it here. Can we see it over here? Is it going to load? Let's take a look at the VIX futures. There we go. The curve is flattened. Not the curve from the sickness, but the curve from volatility futures. This really isn't the largest distance in here. You're only sitting at about 40 cents perhaps of contango out of the vol futures right now. Obviously, this part of the curve is very visually flat. You do have the expiration on the Wednesday session. So you've got VIX futures expiring. You have futures rolling in terms of financial futures on the 20th. You have monthly expiration. It's the quad witching week. It's a holiday on Thursday. You get the Fed on Wednesday. There's a lot of stuff going on out there in this upcoming week's worth of trade, so please be mindful of that. But the main illustration is that we're still in a contango, which is bullish for markets, although that contango is getting very, very narrow. In terms of the one-day volatility index, the VIX one-day, it did not. I think actually maybe if with any bit of luck, maybe we can look at this over here, VIX 1D. There we go. There's your VIX one day. It did not break out over these highs, although it is, of course, elevated. VVIX, let's take a look here. There's that elevation out of this. We could also say LQD, and you could see here how the LQD is trending higher versus, why didn't I just do this? HYG, if you look at this, it's much more sideways. Okay, so here's junk versus LQD, much more of a trend in the upward direction out of corporate grade. Okay, so that's that. Let's go RSP real quick. I have no idea. Why did I not just do this? There's still your equal high, whereas the S&P, of course, broke out. And QQQE, if we look at that, we need an extra Q in there. What I wanted to illustrate here is if you take a look at this, we're underneath that equivalent. So 95.40 versus if you were to go to the, let's just use the NDX because I know I have it labeled. If you go here, you're not underneath that 21.445, which is the same level, right? So NDX, take a quick look, above the level. One more time, QQQ, 3 Qs, and an E underneath the level, okay? So that divergence here is certainly worth paying attention to, and once again, probably leads me to believe, all up for the S&P 500, the base case here is it would not be unreasonable to dip a toe in here. I don't think that we would become overly bearish. We can then look for the lower high in range, in which case maybe this starts to develop. We'll target the bottom end in here, but then we're still looking for that weekly higher low on the higher time frames. All right, that's that. Let's get into the core list of companies here with a broken flex grid for whoever knows what reason. Probably maybe a little restart. We'll fix that. Anyways, NVIDIA, what do we have out of the top dog? Certainly just some balance here into the end of the week. We've actually readjusted some of the levels on the hourly time scale. It used to be, and it still technically is, that this 143.25 is the daily level from off to the left, but this is really just developed as a new balance range in here, hashtag new balance, sponsored. What do we have out of NVIDIA as we walk forward? Well, balance rules are in force. If we get this, great. There's a lot of room to run overhead into the 149.25 target. If we get this, there is some thin structure to retrace off to our left into 137.15. When and if we were to get this, I would be on the lookout for a daily, DHL, daily higher low, right? So 137.15, 136.25 as that zone to the downside, seeking the higher low and some sort of rotation here. Let's take a look at Microsoft. What do we have out of Softy? Ideally, this was just going to yield some sort of 2-day balance range. It's mostly there. It's a little bit of an overshoot on the low. If this persists, I would be really interested in new Brigade bolts to all-time highs up and over 479.75. If you take a look at the hourly time scale, it doesn't look all that compelling in terms of the hourly intraday activity, but once again, it's completely contained inside of, mostly, the Thursday range. And certainly, it's a building block, if you will, in the upward direction. So if we can find buyers here towards this 473.35, seems to me that this could easily play out as higher low here. If we can go risk, reward, and then balloon runners to the top of the range, that's how a range trader might treat it. But really, the next advance is this. Blue sky territories, 479.75, as we just described. If we fall down into this lower block, I'm really just not interested. The intraday action in this block from Microsoft is pretty abysmal. Let's move along to Apple, and Apple on the daily time scale. Not really doing much here. Balance range still, breaking from this multi-day congestion in the midpoint and dragging the market lower with it, of course. So if we could find buyers towards this 193.75 mark, I think that's where Apple has the opportunity to then make a stand. But intraday, it's been pretty rough, right? You can just sort of see how even as the broad market was making higher highs, you really don't have any of that, even on the Wednesday session from Apple. Just a lower high relative to this range in the midpoint. You break, Brigade bolt underneath, and get some follow-through on that Friday session. Next up, Amazon. So Apple, it's very uninteresting to trade as of right now. Amazon actually looks pretty solid as a potential Brigade bolt to the downside here, staying underneath that 214.50. The only thing that would be interesting in terms of a reversal for upside is if Amazon starts to suggest a mosquito pattern, right? Something like this. There's your little proboscis. It's an inverted head and shoulders for those who are not akin to the Trade Brigade terminology. Inverted head and shoulders, but just one day to make the head, or one candle to make the head. If we get consolidation there, then it's got to be this, right? Right back into the equal high. So it's a possibility. It really depends on what the broad market is doing, but 214.50 holds the key for Amazon. If you're above, great. This trade is in play, looking at 217.25, the highs of this, ultimately then 219.25. If you're down here, the best place to get short would have been just the retest, right, for this Brigade bolt underneath 214.50. So I think the short has already played as being there. The next short doesn't really, I don't see it. I really don't see it as being an attractive short kind of in this zone in here. I would really just let Amazon build out some new structure there. Let's move along to Google, see what's going on with the Goog. We've got nice rejection at 176.75. We were actually watching that Friday intraday in the live squawk. So little rejection here, rolling back over. Makes sense, rejecting the top end of the daily breakout level. You could also think of this as sort of double top action, if you will. And as of right now, if it remains below 176.75, I would just maintain a bearish stance. So if we're underneath, right, looking for continued rollover, the only time that this gets bullish is like Amazon. If it turns into a mosquito pattern, maybe this, but I would really prefer to trade Amazon as opposed to Google. The Google chart does not strike me as being as clean as the Amazon one. Let's move along to Meta. Meta is going to be a great possible higher low opportunity on the daily time scale, finally getting a little bit of a pullback after this monster rally in the upward direction, primarily coming from this balance range back here. It's a great spot for a possible higher low as of Friday's low, 682.25. The daily structure does not look great, obviously, closing an inverted hammer weak on the lows there. However, once again, if you overshoot, come back above, again, daily higher low. Let those daily charts guide you. If you can get buyers to step up here, it's a great spot risk-reward wise to try to navigate back up towards the top end of the range. Now, the trouble becomes if you overshoot this and stay below, look left. There's thin structure, right? Really, I think the next appropriate spot for Meta on the daily chart is 661. If you go to the daily, you could see it as the Brigade bolt here. Oops, that's a little shallow on the bolt part of the Brigade bolt. There you go. It's right there, previous high. Right? So 661 would be an absolute top watch for the metaverse. Let's get on to Tesla. See what's going on with Mr. Musk here, building out a multi-day range, but unfortunately underneath this overhead supply. It's actually not unfortunate because I think what it does is it offers some really clean opportunity here on the intraday, right? So if Tesla is going through the process of a reversal in the upward direction after the Musk-Trump drama, whatever, then this is starting to act as a higher low. You have lows, this is a higher low. So the next stage is really, can we get consolidation here and Brigade bolt over 334 to get through this thin structure off to our left? That's a great looking trade. If we can get risk reward like this, I'm really interested in that long there out of Tesla. If Tesla is just going to continue to consolidate, then we'll just treat it as a balance range, right? And if we get this, let's say it consolidates and then does this over time, it's fine. We still have that trade. If it makes an equal low and bounces around in here and does this, then fine. Again, just like we have thin structure to retrace here, we still have thin structure to retrace on the downside. Under 311.25, getting down towards 293.50. Okay? And that is what we have there. I'd be a little less inclined, if I'm being honest, just, speaking about this a little transparently, I'd be a little less inclined to trade the downside. Why? Just you have the two key moving averages, you have this congestion. It's technically the double bottom neckline in there as well at the 303. I'd be a little less interested in trading the downside. There is thin structure, undoubtedly, don't get me wrong. These candle closes sort of negate a little bit of this that was happening in there, but it would just be, I like the upside a bit more out of Tesla, if I'm being honest. Look at the daily chart as well. Not that this is the cleanest hold, but if this is a double bottom, here is your Brigade bolt from that perspective. Yes, there's absolutely an overshoot, of course, but for the most part, the structure on the higher time frame still strikes me as being more bullish than bearish. Let's move into JP Morgan real quick. Nothing to talk about here. Financials really saw the downside based on Visa as well as MasterCard. Large gap downs on the Friday session. I honestly didn't even go and find the news headline. Probably something to do with monopolies, maybe. That's typically what they're always under fire for. Like, oh, you control 80% of the market when it comes to card processing, so maybe there's some law that's being passed. I don't know. We could probably find this out together very quickly by doing something like this and taking a look. MasterCard falls 4.6%. Why? Grim trading session for the stock market. Let's see. There's nothing interesting on that headline. What else? Credit card and payment companies are trading lower following a report suggesting Walmart and Amazon are exploring issuing their own stable coins. Okay, maybe that is it. Ultimately, it doesn't matter. What matters is that price is lower, and if you were to think of this as a double top, you closed right at the neckline. So is it the end of the world? Not yet. We've not developed like this long-standing daily downtrend, but this absolutely starts to look a little bit more like distribution falling out of the range. Little support off the 50, but I would stay away personally. It doesn't strike me as the cleanest trade setup for anything to unfold. But back to the main point, JP Morgan, in terms of financials and banks, kind of stuck sideways in this range. If you look at the hourly chart, a little bit of a look above and fail here on this as a balance range within the overall range, but ultimately, where does that leave us? In the midpoint, unchanged, neutral, not really a bearish data point for the market. If we look at Netflix, this is actually going to start shaping up as a possible bull flag here on the move back over this 1210. If Netflix can stay over 1210, I would be looking for either trendline breaks or something. Swing traders, this is a swing trader's name these days, very, very tough to day trade Netflix recently, unless you're using shares, but options-wise, very tough. If you can get the break of the trend line for the flag, I would be thinking about this. Origin of the breakdown, then of course all-time highs. If you were to look at something like the weekly time scale, up tiny pullback, that no issues whatsoever out of Netflix. So that's really it on the primary core list of companies. However, you may have noticed in the very beginning of the video, we've added Palantir and Broadcom to the core list of companies. They're going to start to graduate. I don't know how they couldn't at this point. They are top traders recently in the market. They're very liquid. They've been moving well. They've been respecting the technicals. So a little graduation ceremony, if you will, for Palantir and Broadcom. Let's quickly check in on these, and then I've got 3 ideas for you outside of these 2 additions, right? So Palantir looks great on the hold over the top end of this balance range. Here, great rally on Friday expressing relative strength. The next trade here is a Brigade bolt straight to blue sky territories over 140. Very simple. If it pulls back, you could look for longs. You could entertain them still off this 133.50, but ideally at this point, consolidation here, build some kind of hourly high or low, then Brigade bolts into blue sky territories, 140. It has to be a watch here. Out of Palantir, it's been trading beautifully over the last handful of weeks. Let's look at Broadcom, the top dog semiconductor, first one to make it to brand new all-time highs. The chart doesn't look as good. Palantir definitely looks way better. However, if this is sort of still that cup and handle, you've got to see this right early on in the week. If you can recapture 251, which is the previous all-time high, then that sort of keeps it in play, and we're thinking about structure building out to the upside, trying to build that next building block, right? Something that looks like this in the upward direction, but it has to happen early on in the week. So the reason I'm including that as a possible idea is just because if this whole drawdown that we saw with the Middle East catalyst is an emotional response and it's overblown, then maybe something that looks like this, poor choice of words on my part, I apologize. If we get this, then perhaps we rotate back up towards this gap, right? That's what we're thinking about in the upward direction, 251. Okay, so if it can hold, great. If it can't hold, consolidation below, I would have to imagine thin structure gets retraced back down towards that 242. All right, that's Broadcom. 3 additional ideas for you. The first one is going to be on CrowdStrike, CRWD. Let's take a look at CrowdStrike, and you can probably see exactly where I'm going with this already, but you're building structure in the upward direction. Notice that we have here the possibility for a block over the last block. Great hold on Friday and a close back. It's an inside bar if you were to look at the daily time scale. Inside bar on Friday relative to Thursday's range consolidation. Brigade bolts out of the inside bar give you a breakout. Over 490 is free air, blue sky territories up and over that level. Next up is going to be MU, which is Micron. If we take a look at this, let's actually leave this zoomed out. Look at this massive range back here, right? Then look at where Micron's consolidating after this breakout of this range from right here. Looks really stable and solid to me with 3 days of balance happening over these previous highs. We have thin structure to retrace off to the left and a gap to close overhead. If we can get, let's take a look in the hourly chart now. If we can get this to play out as a bull flag and we break and Brigade bolt over 116.90s, you're talking about 123. So I love the setup here out of MU, and I would give this the benefit of the doubt. It would stay on watch even if it breaks the multi-day lows here. If it just does something that looks like this, still very interested in Micron, just noting the strength of the rally to get back up and over the top end of this long-standing consolidation. That's a multi-year consolidation, right? So really interesting and impressive stuff happening there out of Micron. Next up, last but not least, is a recent favorite, Oracle, reporting earnings, of course, and going straight on up in the upward direction from Larry. Thanks, Larry. So this is a patience play, please. This is not like, hey, this is in play as soon as the market opens on Monday morning at 9:31. That's not the idea here. The idea is if over time this offers a gentle pullback into this 198.25, or it could even be aggressive. Sometimes it's actually better if it's aggressive because what that does is it gets sellers trapped at the lows. But if you notice that we're pulling back to the previous all-time high, 198.25, this is a play that everybody should have in their basic trading 101 playbook. Pull back, Brigade bolt over a previous all-time high, target equal high. Right? So risk and reward. That is ultimately what I'd be watching for here out of Oracle over the next couple of weeks, the next couple of sessions. Depends on how long and when and if ultimately Oracle tests that 198.25. But very interested in that potential play. Obviously, there is strength and momentum here in the upward direction on the hourly chart. Notice closed at the highs, closed at the highs. I wouldn't chase it at this point. If you're not already long Oracle, I would not just blindly be chasing it at the highs. That's terrible risk management. Your risk reward becomes really, really tough. But if it wants to navigate back here, very interested in possibly looking for the retest long, basically, off of 198.25. That's all I've got for you in today's episode of the weekend episode. Geez, I'm at a loss for words today. If you've noticed, I've probably done that a couple times in today's episode. It's the weekly watch list, all right? It's the weekly watch list, and we've gotten the job done. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember, we will be live every day. We are live every day of the week anyways, at 8 o'clock Eastern time, but in particular, we will be live again at the 1:45 Eastern time frame for Wednesday's FOMC announcement. Come on out to the show and we'll parse out what Jerome Powell has for us, specifically the SEP, Summary of Economic Projections, and his press conference to determine whether or not he's leaning a little bit more dovish or a little bit more hawkish. With that said, check out the links down below in the description. We did just launch the live squawk. It's been going great. We've got 2 weeks under the belt. And, I think that so far it's been really well received. So if you're interested in that, live market commentary, trade ideas I'm looking at, different levels that are in play, market context, feel free to come join us. If not, that's totally cool. Once again, these offerings of what we do here around the channel will not change outside of that. Okay? Have yourself an awesome weekend, and I will see you back here on Monday for the pre-market prep. Have a green trading week, and I will see you in the next one.